So I want to start today with a story about an individual that I was working with recently. He opened up a high cash value life insurance policy with us, and he's approved, about to start. He's going over the numbers, and he just kind of makes a general comment. He's moving forward, but he says, I can do better from a return standpoint in the stock market because he has money tied to the market. He's seen the returns there. But this is my safe money. He was approaching the cash value life insurance policy as a safe asset, specifically focused on cash value. The death benefit did hold a lot of value for him as well, especially how he is going to leverage it from an estate planning aspect. But the cash value, that's his focus. He looked at it and said, I can do better elsewhere, and I am doing better elsewhere, but again, this is my safe money. So we're going to look at what this individual actually did, because this is a significant amount of money he is moving over to a whole life insurance policy. So let's take a look. We've got a 55-year-old individual. Wants to allocate $3 million total to a whole life insurance policy, and one of the plans he wanted to see was moving it over 10 years. Now, he actually did something a bit different than this, but this is just really to set some perspective so you can see what people are looking at. And the numbers can be anything. Could be 3 million over 10, could be 300 over 10, depends on your situation. Flexibility, extremely important to him. He wants to get $3 million into a policy, which would come out to what over 10 years? $300,000 per year. And how he's doing this is he is repositioning cash. But he wants flexibility and does not want to be billed for 300 grand. Meaning, when my policy premium comes due, I don't want to get a $300,000 bill because if I've redeployed my cash elsewhere in some real estate deals or something like that, I don't want to be on the hook for that. So, no worries at all there. What we did was design the policy with the ability to pay in how much? $300,000 per year for 10 years. But the premium we set at $30,000. And then he has the option to throw money into PUAs of another $270,000 per year, the total being $300K. Got a MEC limit overinflated, a little bit over $300K. Term rider attached as well. My point is, he's not billed for or committed to $300,000 at all. Company selection, we don't have to spend any time on that. He wanted one of the best companies, period. He was actually shown a number of small companies that projected phenomenal values, and he asked, have they delivered? Like, not just on paper, have they actually delivered? He has some industry experience. He knew what questions to ask, and the answer was, we haven't ever seen the smaller companies deliver. He goes, yeah, I haven't either. I want one of the best that the big banks, that the big corporations, that the elite use. That's who I want. Ended at that, and that's the same thing I do. Transparency. So this one we had some fun with. So he wanted full transparency on what the policy would look like in respect to the death benefit and cash value over time, not just looking at an illustration and breaking down the columns on a ledger, but what he wanted to see was the best case, but also the worst case scenario, and then a middle of the road assumption. We're going to look at that when we pull up the numbers here. We're going to have some fun. Cash value. So what to look for? This is what he looked for. If you're considering a policy, this is exactly what I would look for every time you see any type of proposal or if you have a policy already. In respect to the cash value, it is a safe, liquid, tax-free area to position money. If you don't mech it out or anything like that, what to look for? This guy right here. Year one cash value, guaranteed, should typically fall between 80 and 90%. Now, if you've seen our older videos, I would always state what? 85 to 90%. Why that is a bit lower now is depending on the insurance company selection. The new 7702 update has impacted some life insurance carriers where we see a little bit less upfront than what we used to. So that 80 to 90%, it should typically be a bit higher than 80%, but that's a safe range really just to look at on paper to know, okay, is this thing set up with a minimum premium or is something not going on here where the premium's a little bit higher to raise compensation, which takes away from my cash value? Keep in mind, I use the word guaranteed cash values there. Break-even point, between 3 and 6 years. His plans for the money. So he is what you would refer to as a cash cow, meaning he's got He's got his assets diversified, but his safe money right now is in cash. Not comfortable putting it anywhere else, it's in cash. Okay, here's a great alternative for him in a high cash value life insurance policy where he can move a percentage of that cash over to a life insurance policy. That's his plan. It's a fixed asset class, tax-free bucket. He's very interested in that because he does not qualify for a Roth at his income, a Roth IRA that is, and then he might use it for income down the road. Might, not certain because he doesn't really need it, but hey, he wants to be able to dip into that policy in the event that he needs it or wants it. And we're going to model that as well with a couple different loan interest rate assumptions. And then legacy planning. So this was huge actually, especially as the conversation continued, is he's got a significant amount of assets, not much debt. However, a lot of his assets are positioned in taxable and tax-deferred accounts, which are a great way to build wealth, and you can live off of those assets during retirement as well. But when it comes to passing on wealth, leaving money to the next generation, if that is a concern of yours, which it is for him, those accounts are not as attractive. Cash value life insurance is very attractive, or I should say any type of life insurance. From a death benefit aspect, it is paid income tax-free. So we're going to look at all of this, and then what we're going to wrap up with at the end of this video is this piece, I can do better in the market. We're going to compare an 8% average return in the market to a policy earning 4 to 5%, and just some things to look at in terms of fees, taxation, to kind of show how those returns are somewhat equal as I compare those two. And again, life insurance, it's not even considered an investment. It's really a fixed asset class. I've got the death benefit, but it is safe dollars where I see it grow over time. That 4 to 5% would be classified in industry terms as an internal rate of return. So let's look at the numbers here. What we will start with is this, specifically the transparency piece. We'll have some fun with this, looking at the best case and worst case scenarios. Middle of the road as well. So a lot of numbers here. Now he specifically stated, I don't want to just see the dividend rate or the cash values. I want to see the internal rate of returns. I want to see the annualized internal rate of return. I also want to see the average internal rate of return. So I mean, that's a decent amount of work as I'm zipping through the software, starting with multiple companies, then narrowing down to one. I love this stuff, so I mean, I have fun putting it together, but it does take time to put those numbers together, the additional reports. Some companies only generate PDFs, so you have to export everything onto a spreadsheet. My point is, if you're in the business, when requests are received, when someone makes a request, someone you're working with, be sure to listen to them, number one, and then honor that request. What always happens in this industry, and I don't know why, is guys think they can smooth talk their clients and prospects to say, well, it's going to look like this. I can just show you this one option. Some even say, well, it's going to be a lot of work, so can I just show you one? I'm like, what are you doing, man? Like, someone's going to put money into a product. You're going to be their agent. Yes, I will do the additional work for you as it is a privilege to earn your business. So if you're in the business, make sure we are listening. Don't try and talk your way out of something or make an excuse. If you're behind, let them know, yes, can take care of it for you. Might take me an extra day or two than it usually does because I'm a bit behind, but it will definitely get you the different options. I can start with a quick one if you'd like, provide them something and let them know you're working on everything else. So here we go. Guaranteed values on the left. What do we see? $300K per year for 10 years. He's 55. Last payment is made at 64 years old. Guaranteed cash values. The guaranteed rate on this example is at 3%. If you have a guaranteed rate of 3%, 4% if it's an old product, whatever it might be, is that the actual earnings rate? I wish. No, that is a gross rate that is credited after the company's insurance expenses, mortality charges, everything. What I want to look at to see what the cash value is actually growing by each year, IRR, internal rate of return. The annual IRR represents what he is actually growing by year over year. Meaning year one, he pays in $300,000. He has just about 250 grand, 248 and change, which means, so he takes about a $52,000 hit. The IRR is negative 17%. So my net performance there, negative 17%, even though I have a guaranteed rate of 3%. I have to have transparency there. Don't tell me I'm earning this attractive dividend rate if I'm negative. So transparency is very important. As the years pass, the annual IRR, he finally starts to go positive. This is based off the guarantees, which it's always done better than this. Starts to go positive beginning year 7. The annual IRR tops out at almost 2.25%. The year it breaks even at 65. It's 11 years to break even. Not super attractive. As time passes, he gets above 1.25% tax-free, but the guarantees, he's looking at those, okay, thanks for showing them. It is better than money I have positioned in cash. Has it always done better than that? Yes, with the major mutual companies, but at the same time, for transparency, here's the worst case scenario. What I firmly believe, and I believe in this product, this is how we drive our business by selling policies, is if someone looks at a worst case scenario and they're not comfortable with it, like a question I like to ask anyone and myself is, would you do it based on the guarantees? And the answer is no. If the answer is no, then what we got to look at or consider is, hey, this probably won't happen. But at the end of the day, it can. It will do better than that, but it can, meaning I want to be somewhat comfortable with the guarantees, an absolute worst case scenario. This way, if I'm comfortable, if that works for me in any way, shape, or form, and it does better than that, I'm happy. If I look at that and say, there's no way I'm doing that, and it does maybe what the dividends do, we're going to look at next, or a little bit worse, it's closer to that, that's where potential buyer's remorse can come into play. So it's just having the awareness and setting expectations first. That's really with anything. That's so important to do. So we don't want to brush over the ugly part. That's my point. Looking at the dividend values, something a bit more realistic here. So what do we see? Year 1's the same, break-even point between years 5 and 6. So year 5, he's paid in $1.5 million. He almost has 1.5. Year 6, he's paid in 1.8. He has more than that. Annual IRR, if we look at, let's look at year 10 to 11, he earned about 4.5%. That is an effective tax-free internal rate of return as well, because it's a life insurance asset. So what that means, annual IRR, is at age 65, year 11 only, it earned 4.53%. The average IRR, I'll circle this in green, at age 65 of 2.43%, what that represents is over the past 11 years, when you started at 55 years old, up until now, age 65, you averaged 2.43%. That's the average internal rate of return, an effective tax-free yield, because this is not a MEC either. If we cashed it out, though, if we just surrendered the policy, we would have taxes doing the gains. And then we've got an index strategy. We can index a whole life insurance product as well. We still have a guaranteed floor of 2% in this example, or 3%, I should say. It's a little bit less than that, but still, we won't go into details on that. Year 5, break-even point. Age 65, cash value 3.7. Strong IRR there. That's an index strategy, though. It might happen. You can go back and forth between the dividend and index over time. I don't like spending too much time on what it should do, because indexing, we don't know what's going to happen. It's not predictable. All right. So if we look at this guy, let's go down to age 85 in this example. Age 85, guaranteed. He's paid in $3 million. He's got about 4.3. He has a death benefit of just over $5 million. So he's paid in 3, guaranteed to leave $5 million income tax-free. Okay. IRR, the average, 1.36. It's about what it tops out at. So again, going back, am I comfortable with that? If not, yes, it should be doing better than that. You can look at a conservative dividend as well, in between the basic dividend and the guarantees. But again, it's good to see the worst case scenarios. Over here, dividend values, world of difference there. Look at that, almost double. And the indexed values are just going to crush it when I look at it long term. There's the basic growth over time. So an attractive product really from start to finish as we look at the growth. Nice death benefit if we look at the dividend assumption, close to $10 million there at age 85. Now, we said maybe income. So with a life insurance policy, when it comes to taking income from the product, you can, and we typically have fixed loan interest rates and variable loan interest rates that will have an impact. So this is a very specific case study because he asked for the best case and worst case scenarios. And he asked the question, or he didn't ask the question, but this is a question I would pose to someone to build awareness, which is, with the fixed and variable loan interest rate, did you know that it actually makes a difference when you pull out income? And when I look at just the non-guaranteed, the basic dividend assumption, the variable loan interest rate looks better. But when I look at the guarantees, different story. Now all of a sudden, the fixed loan interest rate looks better. So in a more conservative interest rate environment, it's better to have the fixed rate. And it's just building awareness in those type of situations. So I know it up front, and that might have an influence on my decision-making process as a consumer. So let's first look at the fixed loan interest rate. Guaranteed cash values, or guaranteed values, I should say. 138, going to the variable, 133. We're going to go back and forth, or we'll just look at the fixed now. So same product, same guarantees. Break even was age 65, but what this shows, 300 grand for 10 years, total of $3 million. Annual income, $138,000 per year, based on the guarantees at that 3% guarantee. Total income is going to tally up the total amount of money he's pulled from the product indefinitely. So up until he dies. I think we ran this to 90 or 95. We'll see in a second. But what I want to look at is if this is me, I want to know, okay, I paid in $3 million. Now I'm taking it back out tax-free, but how much more than $3 million do I actually get here? Let's take a look. So he's pulling out $138 per year, and he can pull it out however he wants. Some years it can be 200, then 50, then 0, then 150. You don't have to turn on a level income stream like this. But we ran it through age 90 here, and what do you notice there? 138 per year, pulled out a total of almost 3.6. He's paid in 3. So he got only another $600,000 back. Granted, it was tax-free. Based on the guarantees, not as attractive there. You only get another $600,000 back. Cash value, a little bit less. A little bit left over. Still have a death benefit, but we drained this puppy. As we look at the dividend option now, though, world of difference, which we can expect it to do much better than the guarantees. So, what do we see over here? At 90, he was able to pull 196 per year, so almost 200,000. He paid in a total of $3 million. He pulled out a total of $5.1 million. So we got us $3 million back, plus another 2.1. To set expectations properly, I might look at an income stream, won't be this bad. That you could consider for me to be comfortable. I would consider somewhere between 150 and 160 to leave a decent death benefit to my beneficiaries at the end of the day as well. And we've got videos that go into retirement planning and such on that. Now, as we progress onto the indexed option, even more, 5.7, almost 5.8 total. Interesting how this works, isn't it? You've got a death benefit left over as well. Now, before we progress on to the next tab, here's what I would like to touch on. Guarantees, and in fact, I'll do it like this. Let me write it up top, or right at the bottom actually. Guarantees on the fixed, you pulled out a total of $138,000. With this, the dividend, you pulled out a total of $196,000 per year. And then the indexed with the fixed loan interest rate, you pulled out a total of $222,000 per year. So we're going to compare that to the variable loan interest rate. Now the thing about a variable loan rate is it's variable, so it can adjust over time. If the loan interest rate goes up, what that can result in is less income produced at the end of the day. Now, there's always the argument of, hey, if dividends go up, or if loan rates go up, dividends are going up as well, so it should offset. But the reality of it is that that is not always the case when you look at the internal rates of return. So I always like to shoot it more conservative rather than just attempt to win a sale or something like that. So what do we see here? Variable loan rate now. How much are we pulling out? So we look at the income amount. So we've got 133 based on the guarantees, variable, 205, and then 233.5. Very technical stuff here. All these columns. But let's just do this now. There we go. So based on the fixed, based on the guarantees, you got how much? 138 per year. With a variable loan rate, it's 133K per year. Now, if that variable loan rate increases, which is at 4%, the guaranteed rate was initially at 5%, and then at year 20, it dropped down to 3%. That's why we were able to pull out more. But with a variable rate, the interest rate can go up, which would ultimately lessen the amount of income you could pull, especially when looking at the guarantees. Based on the dividend rates, however, the variable loan rate, the treatment is non-direct recognition. We see how much? 205. This is the same company, by the way. So same company, same product, same crediting rate assumption, different loan rate assumption. Variable, 233.5. I'm just going to call it 233. So we're pulling out more income with the variable loan interest rate based on the non-guarantees, not with the guarantees. I might run it with a conservative dividend in between just to have more awareness on that. An additional model depends on the individual situation. So a lot of interesting stuff there as we look at the different growth options. We didn't even look at loans, which his plan is to tap into this thing for real estate opportunities or business opportunities, but we cover that in several other videos. So the last thing we want to touch on here is this guy. I can do better in the market. So if you are earning 8% in the stock market, will you ever earn 8% in a life insurance policy, in a whole life insurance policy? No, probably not in my lifetime. It's not going to happen. 3 to 5% is a conservative, good way to set expectations, in my opinion. Historically, it's done better. I've seen one policy produce an internal rate of return. This was an average IRR of 7.1%. However, that policy happened to be issued in 1975 and lived through a very attractive dividend interest rate during the 1980s. That was with one of the major mutual companies. I'm not expecting that to happen again anytime soon. I wish it would, but I'm not expecting it. So with this, what I want to look at is if I am earning 8% in the market or in any taxable asset class, I do want to account for taxes. And as I go through this, I just want to make something very clear. I'm not saying one's better than the other. I love diversification. I think both have a place. You could be looking at this right now and saying, hey, that 8%, I did 30% in the market last year. Some years you are going to knock it out of the park with funds in the market. And you can do that. A lot of technology companies I love. I don't invest there personally just because it's not my thing, but I've seen people do well. I like the Warren Buffett strategy. That stuff works. There's something to be said about it. So don't take this as an attack because it's not meant to be. A lot of people we work with have a lot of money here. But what I want to touch on, just for awareness, got the taxation, 4%, 4 to 5% IRR. Typically I say 3 to 5. Let's call it 4.5 in this example. Internal rate of return. What's the tax issue with a cash value life insurance policy? If you don't cash it out, if you don't trigger a MEC, that is an effective tax-free internal rate of return. So here's what I want to look at is if I'm in a situation a similar situation to this gentleman who's in a high income tax bracket, here's what we want to look at. Let's pull up our software from 1972, just kidding, $300,000 per year. Let's look at a 30-year study, but we're going to stop the payments after 10 years. There's my $3 million balance if I pay 0 in. Let's punch in 8%. There we go. 8% average return. $4.7 million by year 10. This is going to look way better from a number standpoint than the other options we just looked at. However, let's look at taxes. This individual, 35% tax bracket, now all of a sudden drags his actual yield down to 5.2%. Fees could be 0. If it's 0.25%, pulls it down. If it's 0.5%, 1%, what's he at? 4.5%. Depends on who your advisor is. If they charge anything, there's so many different assumptions you could look at there. A do-it-yourselfer, you could have 0. My point here, though, is if I'm doing 8%, I've got taxes and fees to account for. I also have to take on some type of risk for that 8% average. This is good. But at the same time, that individual said what at the beginning of this video? I can do better in the stock market, but the cash value life insurance policy is my safe money, safe dollars. If it's going to produce the same 4.5%, and I don't have to think about it at the end of the day, that makes life so much easier. So I hope you found this somewhat informative. If you enjoyed this video, please hit the like button. It helps us. Please subscribe. Helps us as well. Please reach out to us. That helps us, but we always want to help others first, not ourselves. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.